When you hear the word silver black market, what is your first instinct? Most viewers picture something cinematic: smugglers, crime syndicates, a shadow economy that has nothing to do with the price on their screen. That instinct is wrong, and it is costing you the real story. The smarter question is not whether an illegal silver trade exists in some dramatic sense. The smarter question is why a completely legal, well-documented, and rapidly growing parallel system of silver movement now has the power to influence the official COMEX and LBMA price itself. By the end of this analysis, you will understand the mechanism well enough to see it the next time it moves the market, and I promise you it will move the market again before this year is over. As of Wednesday, July 8, 2026, spot silver trades near $58.53 an ounce, down from $61.36 just 2 sessions earlier. That drop followed President Trump's declaration at the NATO summit in Ankara that the interim peace framework with Iran was over, a statement that sent oil prices sharply higher and revived fears of renewed disruption through the Strait of Hormuz. The Silver Institute currently projects 2026 as the 6th consecutive year of structural deficit, with demand outrunning mine and recycling supply by roughly 67 million ounces against total supply near 1.05 billion ounces. Meanwhile, registered COMEX inventory has been falling for months, and CME Group's FedWatch Tool now prices a meaningfully elevated probability of a Fed move at the end of July as investors await the June FOMC minutes. 3 data points, 1 direction, a market that is tighter than the headline price suggests. To understand why a parallel system matters here, you have to understand what silver actually is underneath the ticker symbol. Think of the global silver market as a single water tower feeding several cities through separate pipes: London, New York, Shanghai, and dozens of smaller regional hubs governed by their own tax codes and import duties. In a healthy system, water flows freely between pipes, and price differences between cities correct themselves within hours because arbitrage traders move metal to wherever it is cheapest to buy and most valuable to sell. But once you attach a toll booth to one of those pipes in the form of a value-added tax, an import duty, or an export license requirement, the water stops flowing efficiently and pressure starts to build unevenly across the system. This is exactly what has happened with silver in 2026. China has formally classified silver as a strategic material and tightened export licensing, which means metal that would normally flow out to meet international deficits is now being held back at the source. At the same time, several European jurisdictions maintain VAT structures on investment silver that create a persistent price gap between metal sold with tax already paid and metal that has not yet crossed a taxable border. Here is the part that most coverage skips entirely. Before we go further, we need to understand that this gap is not a footnote, it is the engine. When the price difference between a taxed market and an untaxed one exceeds the cost and risk of moving metal privately across a border, a parallel channel opens automatically, because the incentive to close that gap outweighs the friction of using official, fully documented import routes. That parallel channel does not require criminal intent to exist, it only requires a large enough spread, and 2026 has produced exactly that spread. Once metal starts moving through these unofficial or semi-official routes at scale, it begins arriving in regional markets faster than customs and exchange data can record it, which means official inventory figures start understating real physical availability in some hubs while overstating tightness in others. This is why premiums on physical coins and small bars have behaved erratically relative to the COMEX futures price throughout the second quarter. The paper price and the true regional physical price are no longer telling the same story, and that divergence is the parallel system asserting itself on the official number. Here is what most mainstream financial coverage is getting wrong about this story. It treats the COMEX and LBMA quote as the single authoritative price of silver, when in reality that quote increasingly reflects only the portion of global flow still moving through fully taxed, fully documented channels. Bank of America's Commodity Research Desk has noted that registered exchange stock has become a less reliable proxy for true available supply, precisely because off-exchange and cross-border flows are absorbing metal that once would have shown up in vault reports. When a meaningful share of physical silver moves outside the system that sets the official price becomes a lagging indicator of reality rather than a live one, and that is a structural vulnerability few analysts are willing to say out loud. If this kind of analysis is the reason you keep coming back to this channel, subscribing is the simplest way to make sure you see the next piece of this story before it shows up in the price rather than after. I am not asking you to trust a headline, I am asking you to stay ahead of a mechanism, and that only works if you are here when the next data point lands. Now hold up a mirror for a moment. There is a version of you that holds silver because you understand this deficit, this parallel flow problem, and the specific conditions under which your thesis would be proven wrong, and there is a version of you that holds silver because the price went up and you are quietly hoping it keeps going up so you never have to examine why you bought it in the first place. The first version has a plan for a 20% drawdown because they have already decided what data would change their mind. The second version will call every drawdown noise until the day it isn't, and by then the decision will have been made for them by fear instead of analysis. This is not about being right, it is about knowing which version of yourself is actually holding the position. From here, the path forward splits into three scenarios worth watching. In the confirmation scenario, China maintains or tightens its export licensing through the third quarter, European VAT arbitrage widens further, and COMEX registered stock continues its multi-month decline, a pattern we will be able to confirm or deny when the Silver Institute publishes its interim supply update later this quarter. And under this path, a widening gap between paper and physical pricing could push silver toward the $70 to $85 range as institutional buyers chase real metal rather than futures exposure. In the normalization scenario, the Federal Reserve's late July decision removes the current rate uncertainty, Middle East tensions ease enough that oil and shipping risk fade from the calculation, and export policy loosens, in which case the parallel channel narrows, the paper and physical prices converge again, and silver likely consolidates in the $55 to $65 range while the deficit story continues in the background at a slower pace. In the disruption scenario, a renewed escalation around the Strait of Hormuz or a further Chinese export restriction triggers a genuine delivery squeeze on COMEX, similar in shape to what unfolded in January 2026 when silver briefly touched $121.62, and under that path price discovery could become genuinely disorderly for a period of days or weeks before a new equilibrium is found. We will not know which of these three paths the market has chosen until the data between now and the Fed's late July meeting and the Silver Institute's next supply release actually arrives, so watch those two dates closely. Here is the question I want to leave you with, and it has nothing to do with a price target. If the official price of an asset can be systematically distorted by flows the exchanges themselves cannot fully see, what does that tell you about the difference between the price you are shown and the value you actually own? Write your answer in the comments because that conversation is one I read and engage with personally. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.